How to choose to invest in a company. In the beginning, every investor has the first question on their mind, which is what will be his first step to invest in a company, or how to choose the right company to invest and build a portfolio. There are lots of things to understand for initial investment. You should have good knowledge about its profits and losses. You should be aware of how long you can successfully stay in the stock market. Although the stock market does not guarantee for long-term profit, it's a place of the type of risk where you can never be rich at any time or another time come back to the down. And therefore, to become a good investor, you must have full knowledge of stocks and its world. Here are some essential steps that will help you to invest better in the right company. Select place to start. There is a simple saying that the beginning is right, then everything is right. And therefore, always invest in a company that is familiar with you. You should have complete knowledge of its background, management, and how those companies plan and how to make money in the share market. If you're satisfied with all these things, then this is your first step to start. Do not go for cheap. Choose the right one, whether it's expensive. There's this big misconception in people that cheaper is always good. They don't see the reason for its cheapness. Sometimes it may happen that the stock is cheap because the business is growing slow or less. Sometimes it can happen that the stock is expensive because in the next few years, it's expected to grow faster. That's why instead of cheap, you should buy those stocks. You should buy those stocks which are likely to have higher prices, so in the future it'll gain more profit, whether it's expensive. Find revenue growth. This one is your third step, where you need to see the company's revenue growth. Sometimes, it can happen when companies earn more money in the long run. Therefore, stock prices increase, which generally starts with rising revenues. You will see analysts' revenues in the form of top line. Look for profit margin or bottom line. The bottom line refers to company's net income or earnings per share or EPS. In reference to bottom, it describes the net income figure on the company's income statement. The company's profit margin is the main difference between revenue and expenditure. A company that increases the revenue while controlling costs will probably extend the margin. Find out how much debt the company has. One of the most important works before investment is check the balance sheet of the company. It's always said that the company's debt is more likely to be more volatile because the higher income of the company goes into interest and loan payments. By comparing the company with their peers, see if the company is borrowing an unusual amount for its figure and industry. Discover a dividend. A dividend is not just a source of cash payment for a stock investor or this regular income. It's just a sign of a good financial health of the company. If a company is able to pay dividends, then you need to see all their payments history and find out if the company is raising the dividend or not. And if you like more videos like this, don't forget to subscribe to our channel.